Good afternoon and welcome to our live webinar, Strategies for Positioning Your Company for Sale and Tax Considerations, hosted by PKF Investment Banking. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. You will have the opportunity to submit text questions to today's presenters by clicking on the Q&A tab on the right-hand panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent to you post-event. A copy of the PowerPoint slides and a recording of today's webinar will be made available to you via email 24 hours post-event. As we near the end of the webinar, we do have a very short survey, which will be prompted, and your response is greatly appreciated. At this time, I would like to introduce Robert Murphy, Senior Managing Director of PKF Investment Banking. Robert?
Thank you, Alana. I'd like to welcome everyone and thank you for taking 75 minutes out of your time today to be with us. We have over 300 people on the webinar today, so we're excited for that. We hope you will find the presentation both informative and thought-provoking. So again, I'm Bob Murphy. I head up PKF Investment Banking. I have about 30 years of M&A investment banking experience. Prior to that, I was the senior corporate officer of a public company handling all the corporate development work. And prior to that, I was a CPA with one of the major international firms for several years. I have worked on over 300 M&A transactions on both the buy side and sell side in a diverse group of industries and geographies. Alberto?
Thank you, Bob. And good afternoon, everyone. My name is Alberto Sinesi. I'm a director with PKF Investment Banking. Really spent the last 13 years or so of my career working on middle market M&A transactions, both sell side and buy side. Prior to joining PKF Investment Banking, I was with Lincoln International for 12 years, both in Europe and North America, where I developed an expertise in the consumer and food and bev space. Look forward to our conversation today, and thank you for joining.
Thank you. Good afternoon. My name is Laura Baruchin. I'm a partner in the Private Client Services Group. Our group focuses on individuals and high net worth individuals and families. We mostly get involved after the sale, but we're going to be talking today about how to strategize before that as well. I'm happy that you've all had time to join us. Thank you. And Bob, we can get things started.
Okay, thank you. Thank you, Laura. So I'll just spend a quick 90 seconds on the firm overview, and then we'll jump right into the M&A trends over the last several years, and then head into what the 2024 year looks like and what's going on. We'll touch upon some valuation trends and key drivers, and we'll address a few different topics that kind of fit under strategic elements for a successful sale, such as timing, pitfalls to avoid, and being properly positioned. And then Alberto and I will turn it over to Laura, who will really address tax planning considerations to address well ahead of a sales transaction. And our plan is to leave 10 to 15 minutes at the end for Q&A. So PKF Investment Banking is part of PKF O'Connor Davies, which is a full-service accounting and advisory firm with a long and impressive history dating back to 1891. The firm has over 1,500 professionals and over 200 partners in 18 offices, and access to international network of resources in over 400 cities through the PKF International Network. The investment banking team have collectively in our careers closed over 300 M&A transactions on both the sell side and buy side and capital raise engagements as well. We focus on privately owned, family-owned companies that are typically generating revenue as low as $8 to $10 million, up to $300 million. 85% of our engagements are on the sell side, and approximately 15% are on the buy side. We cover several different sectors, including business services, professional services, consumer, food and retail, manufacturing and industrial services under the Diversified Industrials Group, value-added distribution, and software and IT services. So let's kind of just jump right into the M&A trends. So the chart here at the top shows the completed transactions by year from 2020 through 2023. And it shows the total for the year going across the top, and then below that, the deal count by quarter. So let's start in 2020. There was approximately 15,000 transactions completed in North America. And just to give some perspective on that, in 2018 and 2019, there was approximately 15,500 to 16,000 transactions completed in each of those years. And those were considered strong years. And so as we moved into 2020 and had almost 4,400 transactions close in the first quarter, we felt good. We all felt that 2020 was going to be a good year, and obviously COVID hit, and I think everybody's sick of talking about COVID. But COVID hits in the second quarter and puts a real pause on the M&A market, just like it did in pretty much the whole economy and every sector. And the transaction volume dropped significantly down to 2,400 completed transactions. Things picked up a little in the third quarter, but still really trying to figure out where the economy was going, where real estate was going, where the job market was going. But by the fourth quarter, there was a rapid recovery. And in the fourth quarter, there was almost 4,900 transactions completed. And that rebound continued right into 2021, where every quarter of 2021 was a very strong quarter. The third quarter was over 5,000 completed transactions, and the fourth quarter was over 6,000 completed transactions. And I remember, when stats came out and talking to other investment bankers and equity firms, that we were, everybody was really double and triple checking these numbers. They just seemed kind of unbelievable. So the 2021 year at over 21,000 transactions was a record year by far. The fourth quarter was a record year. And so what drove that? I mean, the first thing that drove it was the pent-up demand due to COVID, right? So deals in 2020 that paused and didn't go to market, deals that were in market and got pulled and pushed into 2021, and deals that cratered that got pushed into 21 and beyond. So that was a big one. The other was the low interest rates, all the government stimulus, a strong stock market, all those things converged to have a record year. And moving into 2022 started off as a pretty strong year, and the first half overall was. But anybody in the M&A market, whether equity firms, bankers, advisors, we could all see things starting to change a bit with sentiment in really the June, July period. In the second half, clearly was a much different environment. As a total year at 19,000 transactions, still a very strong year, but kind of a changing dynamic. And that change in dynamic was due to the higher interest rates, economic concern and uncertainty, geopolitical tension, all had really, and inflation, which we all remember, all really started to have a big impact towards the end of 2022. And that carried into the 2023 year, where the total transactions we're estimating, once everything's reported, will be 15,800 to maybe as high as 16,000. So about a 17.5% drop from the 2022 year. And if you look at quarters, you'll see every quarter was down from the previous quarter, and things really leveled off in the third and fourth quarter, where we're estimating the final count will be 3,700 to 3,800. And that's what we're seeing in the first quarter of 2024. We're estimating we're going to be around 3,700 to 3,800. So things have kind of leveled off over the last 6-7 months. Just to kind of recap 2023 real quick. So the primary driver of the decrease in 2023 is really the higher interest rates. And those higher interest rates result in increased borrowing cost. And that increased borrowing cost puts pressure on the valuation multiples. And then compounding that was a tighter credit market where there was not as much debt leverage available for equity firms to fund transactions. So between the higher borrowing cost, which brings down your cash flow, and then a larger percent of equity required in the deal, bringing down the returns, that all had the pressure to bring down valuations, which then created a disconnect between buyer and seller value expectations, which was persistent, all through 2023. About 75% of the transactions completed in 2023 were add-ons by private equity firms. Those add-ons where they're doing bolt-on acquisitions to an existing platform, they are normally using their existing credit facility. So the financing is much easier, and those transactions tend to be a bit smaller. So the add-ons was a strong sector. And then the other thing we saw across the board in many transactions was an increased usage of earnouts, seller notes, and a higher percent of rollover equity. All effective tools to deal with less debt being available and to help bridge that value disconnect gap, and also just deal with the overall market uncertainty. For 2024, with regards to just M&A volume, we think the 2024 year will finish out fairly close to the 2023 volume. We think the second half will be a bit stronger. Of course, going into the year, we were all hoping for 3 or 4 interest rates cuts, which does not seem to be happening. So we think the volume for 24 will be pretty much in line with 23.
Well, thank you, Bob. Why don't we take a look at the underlying EBITDA valuation multiples over the past really 20 years, as you can see at the top of the page. So at the high level, depending on which enterprise value range you look at, you will see that valuation multiples were either flat or down by half a turn if you compare 2023 versus 2022. Now, for larger transactions, meaning those with an enterprise value over $100 million, multiples were actually lower by half a turn or even a full turn as compared to 2022. If we look at the year-to-date period, 2024, our observation is that multiples remain relatively in line with what was observed in 2023. So similar to what Bob just talked about. If you look at the bottom part of the chart, which showcases debt to EBITDA multiples over time, you will see that the total leverage quantum declined from the peak of 2021 through 2023, right? So from 4 times total leverage to 3.6 times, with the key driver of such decline really being the dark portion of the stack chart, which is the senior debt. Whereas the more junior type of capital remain relatively constant, which frankly is common in the industry. The only other thing I'll add here is that the same leverage quantum that is being shown here in 2023 remain relevant or relatively consistent through the year-to-date period 2024. Okay, so it's that period of adjustment, if you will, or stabilization, if you will. The next page, we thought this one was a good page because it really showcases the dynamics here that happen in the market over the past 12, 15 months. I'll walk the audience through the page here. I think the key metric here is this number, the 128% premium, which is essentially the premium that buyers paid for above average performing companies, which is defined as those companies with a trailing 12 months or TTM EBITDA margin and revenue growth being both at least 10% or one of the two being either above 12% or 8%. As you can see, 28% or 128% was the highest premium paid over the past 20 years. And it's essentially the ratio of 8.2 times, which is the average EBITDA multiple paid by buyers for high-performing companies versus the rest of the cohort of potential sellers. So highest premium, and at the same time, the lowest incidence, which is to say that there were very few quality assets out there in the market being syndicated. And for those assets being syndicated, the competition was stiff, which explains the pickup in the premium. Again, very interesting dynamic, but which also talks about the lower M&A volume observed over the past 18 months or so. Looking into 2024, there's definitely a good number of positive indicators, right, that point to a pickup in M&A activity and M&A volume overall in 2024. Just to name a few, just a sheer backlog of M&A transactions in 2023 or from 2023, and frankly, even 2022, meaning deals that haven't been consummated for a number of reasons. Those at some point will have to be brought back to market. Strategics, right, have been pruning their portfolio of brands and assets, really focusing or refocusing on strategic assets. And then lastly, just a sheer amount of dry powder out there from a private capital standpoint, whether it's debt and or equity, and frankly, also the cash on hand by strategic corporations. It's just a proxy for the activity that will happen at some point. And then needless to say, just the amount of pressure that financial sponsors are facing with respect to their limited partners, right, who are pushing them to both deploy capital, but at the same time also return capital. Again, the economy overall and the M&A market still facing some significant headwinds. One of them is clearly the persistent high level of interest rates, right, with the unclear timing as far as the cut is concerned. Mixed economic or macroeconomic indicators, right? A strong job market, inflation, which is still above the 2%, targeted by the Fed. And then again, the persistent buyer-seller valuation gap, right? That is certainly something that is still out there and will need to be faced. And then there is a number of other considerations that are uncertain as to what the impact will be, and even if there will be an impact, again, geopolitical uncertainty and the upcoming federal elections, we can certainly talk about it. So overall, the key takeaway here is that there are certainly indicators that point to a pickup in M&A activity, but the trajectory and the shape of that pickup remain relatively uncertain at this juncture. This page, and I'm going to just focus on the right-hand side, these are just a few select sectors that have observed resilient M&A activity. Some of them are, clearly so, right, just given the nature of their revenue streams. So tech-enabled services or healthcare service and business services alongside SaaS, so service as a software as a service, financial services, everything that gravitates around technology but has a functional element to it and has a recurring revenue pattern gravitating around it. Those have been performing really well. The second bucket are all sectors that have a functional element to it, but gravitate around something that is of value to a person or a family, whether it's a house or a car or even personal property such as jewelry and the like. Those have been really strong. So think about engineering services, architectural services, automotive aftermarket, i.e., collision centers, car washes, oil changes, tire change centers, right? Those fragmented industries have been resilient, right? And the same thing for roofing, landscaping, HVAC. Those have traded for high multiples. And then from a consumer slash food standpoint, pet has been a resilient area alongside better for you, health and wellness products, and then frozen foods and ethnic foods. Again, coming out of COVID, the long tail of COVID, and these really macroeconomic slash secular trends, if you will, those have been resilient and have witnessed strong activity.
Thank you, Alberto. So getting the timing right with the sale transaction, this is a conversation we constantly have with business owners and typically many times with the same business owner. It's very particular to the situation, the personal situation and the company situation. So when we have these conversations, there's really three buckets that we talk about, and you kind of look at those three buckets to really kind of figure out what timing makes sense and doesn't make sense. So the first is being the personal factors of what's driving the conversation and the thoughts. Is it the fact someone just wants to retire? Is it the fact that they're just burnt out or they have other business interests they want to pursue? Is it a need to get more financial support into the business to support the growth and deal with industry challenges? So what are those personal factors? And then the other next bucket is just looking at the business itself. Are there major contracts coming up for renewal? And if that's the case, then going to market, you probably want to wait till those come in. Are there product or service launches that are in play that will drive future revenue that makes sense to get a little further along with? Are there different competitive or industry changes going on? So you kind of look at all those things. And the last bucket, you really look at the M&A market for that sector and what kind of deals are transacting and at what multiples and what is the demand and what's going on with the overall economy. And you kind of blend all those together to figure out maybe what's the right timing for that situation. Just to give an actual example, we had a client, Stronger You, a few years ago. The owner was 38 years old, and his driving reason was he had built this company fairly quickly, very successfully, felt it had a lot of growth potential, but didn't feel he was the right person to execute that next phase. And that was kind of the driving factor, along with the ability to get financial security and diversification. On the other hand, we signed up a client a few weeks ago where the husband and wife owner are in their early 60s and realize they're still pretty important to the company, and that any transaction they're probably going to need to stay for 2 to 3 years. They'd like to get positioned, to be out in the next few years, and the company's performing well, and the market for their sector is strong. So it's just very particular. But the one thing every owner should make sure they know is, why are they pursuing a sale? What do they wish to gain from it? Is it just the highest value they can get? Is it additional investment into the company as well? Is it a certain culture and fit they really need for the employees? So that that kind of covers that there, Alberto. Skip that. Right. So just want to take a little time to kind of talk about 6 pillars or 6 things that we feel are very important to have in place prior to going into a sale process in order to drive value higher and increase the certainty that the transaction is going to close. So the first kind of item bucket here is really dealing with highlighting all the things that make the business valuable and attractive. So could be the recurring nature of the business. It could be the management depth. It could be the margins. It could be the recent growth, the IP in the business, but all those things that make it attractive and a value add. And then the second thing is making sure you can articulate a future growth plan. A big part of where a valuation multiple falls is the growth. So you have 2 companies in the same business, similar size, maybe one trades for an 8, the other trades for a 7 multiple of EBITDA. Well, why is that? A lot of times it comes back to the growth profile of not only what the growth has been, but where is it going? So being able to articulate, and even if it's items that the business owner is not executing on, that's okay. It's just what can the right buyer do with this business for growth? Can they expand services? Can they expand into geographical areas? Can they introduce new product? And being able to articulate that with a reasonable level of depth to make it tangible. The next bucket is just dealing with the transaction structure. Is it going to be a stock sale or an asset sale? Is there a reorganization that needs to take place? And then also dealing with all the personal and pre-tax planning considerations that Laura will touch upon in a few minutes. The next bucket on the top right here, number 4, is just addressing all the potential issues. You don't want to get into a process, have due diligence issues come up, which then slow down the process. And once you slow it down, you increase the chance that the deal gets renegotiated or the deal craters. So whether it's sales tax issues or nexus issues or proper IP documentation, dealing with those things ahead of time, and then also being ready to address issues or concerns a buyer or investor will have that you can't change, such as customer concentration, and being ready to address that the best you can. The next thing is just the internal team, realizing who needs to be involved and when to bring them into the process. And the last thing is just getting the right team around those business owners, from the M&A advisor to the corporate M&A attorney to the tax specialist, wealth advisors, what have you. So just trying to quickly touch upon kind of 6 key things we think is important to drive value and drive certainty to close.
Thank you, Bob. And I think we can skip this page.
Okay.
To the extent there are any questions after we release the document, more than happy to address. But I think we should spend a couple of minutes here on this page. And Bob, you tangentially talked about several of these pitfalls, right, or common drawbacks that entrepreneurs do face, right, or should consider prior to contemplating a sale. So you talked about addressing potential liabilities, right, a tax structure, right? You talked about all of that, and frankly, also making sure that the right corporate/M&A attorney is being hired, incredibly important. And then there is a number of additional items that are as critical as the ones that we just referenced. The first one being never discuss value with a potential acquirer when you are contemplating the sale of your business. You don't want to anchor a buyer on a specific value. You should leave that to your trusted M&A advisor. You'll be surprised how often that happens. But it's important that those discussions are being held internally, and then have the M&A advisor handle that piece alongside the whole negotiation. in the process. The other item is making sure that each buyer, and especially that one that is being selected to consummate the transaction with, is being heavily scrutinized and assessed from a viability standpoint. Has this particular buyer ever done M&A transactions? Do they have enough capital to consummate the deal? The other one that I will just emphasize is just make sure that by the time the LOI is executed, the buyer has really vetted as much information as possible, meaning the data room should be up and running and being ready to be reviewed by buyers, such that in the LOI all of those configurations are reflected. And ultimately, the LOI should be as granular as possible, whether it's on the purchase price consideration side or the deal structure or plan with respect to management team, areas of envisaged diligence work, right? Timing to closing, all of the above, really. So again, there's a number of considerations that are key here to an owner or owners when they're thinking about positioning their business for a potential transaction.
We won't take the time to cover all these, but this is a list of some real life deal challenges that we put together, and of course we could have pages of them, but we'll talk about a few. The second one here was a tech-enabled consumer services company, and they thought that their name was trademarked. And once again, it's a consumer service, so the name is very important. And the buyer in this particular case was a big investment group that owned multiple consumer branded services. And so branding and trademarks was very important. And the company thought that the name was trademarked. And as we put together all the information, went to market, and we're still doing due diligence, it came clear that it was not approved yet. And during the process, we actually received a letter from the patent office with concerns that there was another company with a similar name. And that got resolved by escrowing 25% of the purchase price, which is a huge amount, which was the value they placed on that name. Our client and us and the advisors we had were confident that it would get resolved, and it did get resolved about 3 months after closing. Another situation we had, a consumer product manufacturing company had 95% customer concentration. So this became an exercise before going to market of how do we best position and deal with this? How do we get this transaction done? As most people, I'm sure, on this webinar realize, most equity firms, they don't like concentration at all, and they sure don't like 95%. So what we did here is the client was able to get the contract extended, so at least it went out a couple of more years. And then we really worked with them to identify and develop how deep the relationships were with this customer and all the benefits to the customer and why they were using our particular client. And then we targeted specifically strategic buyers that we felt would really benefit and want the relationship with this customer. And so that transaction got done at really just a slight discount to what it would have been if they had not had that concentration. And then just kind of a simple one, an industrial service company that had long-term contracts. As we were doing our work, it became clear that the revenue recognition and the revenue trends didn't look right. So there we, before going to market, just engaged with an accounting firm to correct the revenue recognition and do a quality of earnings report. And I think, given time here, I think we'll kind of stop here, Alberto, and we'll turn it over to Laura so we can kind of wrap up and have at least 10 or 12 minutes for some Q of A.
Great. Thank you, Bob. Thanks.
Yeah.
So we'll jump right into the tax considerations, and I don't want to be redundant, but I think based on what you just heard from Bob, I think one of the best things that you can do is start planning early and have a plan. As Bob reflected on, as he mentioned, is this your first exit? Is this one of many exits that you've been through before? Have you been through this process? Are you looking to take cash off the table or roll this over into another venture? Making sure that you understand what's most important with your plan and what your goals are. One thing that I've had a client say is, every one of my employees has to land at the new company. That's a priority for me. That's a go, no go decision. That I need to, take something off the table, that this is my retirement. So this is the one time that I'm going to have to do this. So understanding what that goal is, and then determining, as Bob said too, who's involved in that plan development, in the execution, and most importantly too, in the follow-up to that plan. Who's going to make sure that, that someone's on a particular on the board, who's going to do reporting after the fact, who's taking care of those employees to make sure things are landing. So making sure that you understand what those priorities are to you and which advisors, family members, employees need to be involved in those conversations. Getting some of that done up front can avoid some surprises and maybe some hurt feelings or someone being left out of the loop later on, which can also lead to slowing down, a potential deal. So making sure that you understand that and understand what are those go, no go, things, items for you. And as the business seller is making sure that everyone's on board with what those items are. Also understand change all those challenges that Bob laid out and all those things that are going to happen. The deal may change. Do you understand what those, what are your, again, those go, no go decision points, but what are the different scenarios under which you would consider, continuing on with the sale? What goals may shift or which goals you may be willing to give up something on to get something else? And one of the most important things, there's only so much that you can control as you go through a deal, any sale, whether you're selling your home, you're selling your business, you're embarking on a new venture, there's only so much you can control. And one of the most significant and quickly evolving areas right now is tax legislation, and specifically state tax legislation. And we're going to talk a little bit about that. Is for many years, and many of our attendees here are New York based or Massachusetts based or from anywhere, know what your state rules are and make sure that you know that your advisors know what the state rules are and what's changing. As I was preparing for this, I actually found an article from two of our colleagues here at PKF O'Connor Davies that go all the way back to 2018 and talked about the evolving and expanding New York tax legislation surrounding the sale of businesses for individuals who've left the state. So they've moved out, and how New York was still going after the sale of businesses and entities that are effectively connected with the state of New York and or the city, and how they were still evolving and expanding that rule to include things like New York co-ops and other things. So knowing what is happening both at the federal level and at the state level, there's an excellent series of articles under the New York State Society of CPAs that Craig Riley put out in September of last year that talk about after the move and what's happened and monitoring this specifically with regard to New York is, as he says, New York residents are taxed on one thing, and that's everything. So being prepared for that, knowing where you think maybe a move may help a strategy to reduce that tax hit may or may not be. And every state is a little bit different. And here in Massachusetts, we had a case in November, an appellate case that ruled in favor of the Mass Department of Revenue, that said even though the taxpayer had left the state, because he was significantly involved in the business for many, many years, in the decision making, in the appreciation of the sale price that ultimately happened, all of that is Massachusetts source gain and effectively connected to Massachusetts. And even though he had moved to Florida, that will continue to be taxed at Massachusetts tax rates. And as of the beginning of last year, we now have a millionaire's tax. And so that can be quite significant. So knowing what's happening at the federal level and being prepared for it, again, it's not something we have control over, but understanding what impact that may have on your deal and how it's being structured is critically important, as this is a rapidly evolving area. So what can you do besides, like I said, sharing the plan with your impacted participants, with your advisors, getting that input, getting yourself ready for that? Maybe one of the things to consider, and it may not help reduce the tax bill, may or may not, but getting ready and doing things early is maybe consider tying in some estate planning. Early, maybe family gifting when the value is lower. So making sure that you understand, having someone come in and really taking a close look at your business and what is the current valuation. Do you need to do any of that housekeeping and cleanup that Bob was talking about? Maybe gifting into things like family partnerships, family limited partnerships, or other entities will allow you to take some discounts to that value on the estate planning side of things for lack of control and lack of marketability. Understanding what impact those items can have and those moves can have may shift the taxes to maybe someone with a lower tax rate or to an entity with a lower tax rate. It may also just provide, in the long run, estate planning savings as well. Maybe considering transferring assets to a state that doesn't have income taxes. Do you have things that can be shifted? Does the business move? Are there other longer term items that need to be done well before a sale is considered so that those things are set and part of the deal and don't negatively impact a sale price on the back end? One of the things also to consider is your company structure. What is the best saleable entity for you? Are you a partnership, an S Corp, or Section 1202 specifically deals with qualified small businesses. That's businesses under $50 million of assets, in C corporations, in certain types of industries. It's a very narrow code section, but Section 1202 has been around since 1994 and allows individuals, as long as they hold on to the stock in the corp and they sell that stock on the back end, to exclude a significant amount of gain, up to $10 million worth of gain. And that can also tie into estate planning. But that needs to be done well ahead of a sale. That's not something you can decide once you've got an LOI and someone's in the middle of due diligence. So understanding, what does your company structure, what is it, and how does that impact what it is you're selling and what someone may be interested in purchasing as well. So what can you do? So reducing the taxes, certainly considering a charitable gift. If charitable gifting is part of your longer term plan, part of your sale plan, then making sure that there's maybe been a transfer of shares before an LOI has been signed. There's a tax court case that disallowed the seller a deduction for the charitable donation that he made. It also included the entire sale price in his tax filing and allowed the charity to retain the property. So it was extremely punitive because they did the transaction, the transfer of the shares right before the sale. And the tax court will look at this and say, there's just no way. So consider, if you are thinking of part of your strategy is longer term philanthropic planning, then think about making a transfer or setting up some type of charitable vehicle well ahead of the transaction. You can also, after the deal closes, certainly can gift proceeds and any remaining cash or something that comes out. The individuals can also do gifting and charitable gifting. But again, that may be something before or after, or depending on, again, what those goals are that we talked about in the beginning. An installment sale may be something as part of your deal, deferring taxes until those later cash payments are received. Now, there's some risk there. One is that tax rates in the future may be higher. So you may get some deferral, but might the rates that you'd be paying later on those subsequent receipts outweigh the deferral benefit. So that's something to consider and something to model out as part of what your terms are. There's also risk that maybe the value decreases, maybe those benchmarks aren't hit and those subsequent payments are lower than you anticipated. So again, much to talk about as part of going through your deal analysis, but something to think about of where do we think tax rates may be in the future? And is there that deferral opportunity, something to consider? Another code section for you here is 1031 exchange. Is there an opportunity, depending on what's being sold, is there an opportunity to exchange property and defer tax liability as part of a reducing tax or deferring tax? Again, deferrals are great, but potentially those higher tax rates later on as well. In understanding what those are, and does your particular sale fit within the boundaries of Section 1031? One area that gets a lot of time spent on it during the deal is negotiating the purchase price allocation. And how will that purchase price be divided up? Is it going to capital gain assets, which are at lower tax rates than ordinary tax rates? Things like customer lists or accounts receivable or inventory items that may be at higher tax rates than a stock sale, which could be at a capital gain rate. So again, something to understand ahead of the deal: what's being sold, how are those being classified, how does the IRS look at those assets, and then what would you be willing to negotiate on? Because the buyer may be looking for assets that can be depreciated, and the seller may be looking at assets that can get capital gain treatment on them. So understanding what those buckets are and where you have some flexibility can help with the negotiations as well. Asset sale planning, again, is assets, understanding what your basis is in the assets. So one of the things that we will work with clients will understand is, what was your purchase price? What's been added? What's been taken away? What's been depreciated? Understanding what that tax basis is, and knowing that your sale price less your basis will get you to, with some other things in there as well, but will get you to what is your taxable event. So making sure you've got really good basis records, because the other thing you don't want is you don't want the IRS or the state jurisdiction coming in afterwards and auditing and looking at, basis numbers that might be soft and that there's some additional gain that they may be looking to capture as well. And one thing to consider, much like the 1031 exchange, that just defers you, and that gives you a new asset and defers the tax that you have. Maybe a tax-free reorganization, something like a stock for stock exchange. Now, that will defer any tax you have, and it keeps you engaged in the business. If your goal is to take money off the table, step away from the business, sail off into the sunset, literally, then maybe, being involved in another business and being on the board and having to go to work every day is not what part of your goal is. But if there is a candidate, if there is a potential buyer that you're really interested, you love the upside, and maybe like in Bob's previous example, where the individual just didn't think he was the right person maybe to take the business to the next level, but he wants to be involved in that, or she wants to really be part of the team that's going to, land the employees softly and continue this into the next generation and the next iteration, then maybe a stock for stock exchange is something that's very appealing to the seller, where we can avoid the taxes now and just take that and roll into the next venture, and hopefully on the upside watch that appreciation continue, and then look at a sale kind of on the back end or an exit on the back end. One of the other areas I put the net investment income tax. So on January 1st of 2013, the net investment income tax came in to the federal tax code, and it applied a 3.8% tax on investment income. We are a decade past that at this point, and I continue to see tax returns that we will get from potential new clients that'll come here and we'll take a look at them, and that the net investment tax is being applied to the sale of active business transactions. So for example, I take $100 and I put it in the bank and I earn interest income on that. I may be subject to the net investment income tax on the interest that I've earned. Depending on my income level, depending on my tax situation, I may be subject to that 3.8% tax on the income that I earned on that interest, because it's considered investment income. I sell my business that I've actively been involved with every single day. I am a participant. I materially participate. I meet all those certain tests and rules, and I own, my entity, and I sell my entity. The net investment income tax may not apply. And it's important that you look at what is being sold, what has been your activity level. Have you retired and you're selling it a couple of years later? Maybe the family's selling the business now. How long were you involved? What was your involvement? And what exactly is being sold? The regulations under this particular code section are complicated. They have been evolving since the tax came in 2013, but that tax may or may not apply to you. So knowing that it does or does not, 3.8% of a big number can be a really big number, and understanding whether or not it applies to your particular situation, your client's situation, is very important, because you don't want to end up paying 3.8% that you didn't have to pay. So I put that on there is just to make sure that you look at, kind of like I said, what is being sold, what your activity level has been as well, and whether or not that 3.8% is going to need to go to the IRS. There we go. There are a few things to do after the sale as well. One thing I find many of our clients, I'm part of a team of 50 here and 8 partners. And as I said in the beginning, most often we see the individuals after they've had the sale, and now they're looking for their help with their particular, their personal taxes. They've got, new investments that are happening. They've moved from an active business to, more of a retiree potentially, or maybe that serial entrepreneur that's just looking for the next venture. What kinds of support might you need? Things that maybe had been, taken care of as part of the business or separately. Maybe there's a lot more funds now. So having a bookkeeper, having someone who can help you keep track of those installment sale payments that are supposed to come in, those contingent payments, making sure that, that if you're still connected with the business, the new business in some way, that things are being monitored as, with a personal assistant being involved in that. Are you still sitting on the board? What business resources might you have relied on as part of having your own business that now need to have someone so that you can go sailing off into the sunset and not have to worry about that? Information that's needed for tax filings, subsequent tax filings, those, again, the collections and filings and tax payments later on. One thing I also see is that shift from withholding. If you were the business owner or part of the business team and you were, subject to, you had wages and you just had your withholding and everything was great. Well, you may now have shifted into the area of estimated tax payments, making sure that those are done at the adequate level, at the appropriate time, avoids any underpayment interest. So again, why give the government, state or federal, more than they need? So making sure that those payments are monitored, that they're coming at the right time, that they're being calculated appropriately, and taxes are being remitted when needed. As I said, tracking those subsequent payments, that is probably one of the most often things that I see can sometimes surprisingly just be missed, or understanding where is the business that's making those subsequent payments. Are they being received, and are they being reported correctly after the sale? So making sure that that's being done, and then considering additional charitable gifts to mitigate the subsequent tax burdens as well in those following years. If those payments are still coming in, then making sure, are we making enough charitable? Is that still part of the plan? One of the nice things about charitable is you offset ordinary income tax dollars before capital gain dollars. It's a very taxpayer friendly ordering rule. So if, for example, you receive $100,000 of ordinary income and $100,000 of capital gain income, by donating $100,000, you're reducing your tax bill from an ordinary tax rate maybe down to that capital gain rate. And again, add some zeros and some commas onto those numbers, and it can really have a significant impact. So considering whether or not additional charitable gifts are something also that will help mitigate that future tax burden is something to watch for. That's what I had for the strategies and items to consider. I think we want to open it up to some questions, and we've got plenty of time here. So Bob, I don't know if you had a chance to take a look at the questions that have been posted already.
Sure. Thank you, Laura. Great job covering all that. Well, maybe we'll kind of start with kind of a tax question, and maybe I'll kick it off, and Laura and Alberto, you can chime in. But someone asked a question, stock sale versus asset sale, pros, cons for buyer, seller. And I mean, literally, we could do a 30-minute webinar on this alone. But, just a couple of things. One, if you're a C Corp, you definitely need to sell stock. If not, you'll have double taxation. A C Corp, they'll sell the stock. If they sell assets, the corporation will have a tax event, and then when proceeds are distributed, it'll get taxed again. So if you're a C Corp, we've really never found a way around it. We pretty much would go to market saying it's got to be a stock sale. The other thing, from a buyer's perspective, they want to get the tax treatment of an asset purchase. And once again, so that can be done as an asset purchase, or it can be done as a stock purchase, but then certain tax elections or something called an F-reorg can be done. So it's treated as an asset purchase for tax reasons. So once again, from a buyer's perspective, if it's a straight stock sale, they can't write up any assets and they can't deduct the goodwill. And so in most cases, most of the deals we do for tax purposes, it's being treated as an asset sale because we'll get a better value from the buyer. And as long as it's not a C Corp, while there may be some additional taxes for the seller, one, will ask the buyer to reimburse and gross us up for those. And even if we can't, that difference normally is outweighed by getting a better purchase price. So just high level, that would be my response. I don't know if Laura, Alberto, you want to add anything?
That's great.
One easy question was asked early on as far as the volume of M&A transactions we were shown. Does that include all transactions? So yes, it does, but no database is perfect. We're pulling that from various databases, so none of them are perfect. But yes, it should include all of them from the smallest to the largest. And I would gather that some of the real small deals at below $1 million, I'm sure not all of those make it in there. The next question is a fun question. So we'll ask Alberto to take out his crystal ball.
Valuation hat.
Yeah, no, the elections. So what do we think about the election and the impact on the M&A market?
It's a good question, Bob. Look, if we look at the last few election cycles and how M&A was affected, I think we can say that we should be relatively comfortable that this year we don't think there's going to be a huge impact. This is at a sort of general level. Maybe there might be some softness or uncertainty around or the few days leading towards the election, but we don't foresee a major impact unless we're looking at industries that might be affected from a regulatory standpoint. One that comes to mind is medical billing, right, or industries where there is a potential impact with respect to tariffs, right? But generally speaking, we think that the market will be relatively in line with how it was in the other part of 2023.
And Bob, one thing I'll mention is just to level set everybody to the current tax rules that we have right now are in place through December 31st, 2025. What is going to happen on January 1st, 2026 is the tax law will revert to what it was in 2017. So all of our ordinary income tax brackets will narrow and each of the rates will also increase. So one of the things that we're looking at, and most importantly, I mentioned estate planning, one of the things that we'll see is the current almost $13 million per person estate exemption is going to settle somewhere around, the numbers are soft, but somewhere maybe $6.5 to $7.5 million per person. So everyone's gifting capacity today, tax-free gifting capacity, is double what it's likely to be on January 1st, 26. Now, what impact November has on that and a new potential administration or current administration, who knows? But that's the reality that we have right now. So we're doing a lot of looking at those values that, family transfers, things like that, to make sure that we're in the right position and we're not waiting until next fall when everybody might be scrambling to do some transfers. So that's something to consider as well.
Okay, great. We've got a question here. When seller financing is involved, can the agreement mandate that a specific percent of gross revenue be set aside in a separate account for future debt service payments? So in 30 years, I've not seen that. I think that would be a challenge because I'm assuming that there's some type of bank financing or some type of financing involved. And so that seller financing is going to be subordinated. So they're not going to allow for any type of special fund allocation. What we try to do the best we can with working with the lawyer when we have seller financing is if there is a parent company from the buyer, we'll try to get a guarantee from that parent company, which is actually what we're doing on a current deal right now. We'll make sure there's a provision that no distributions can come out of the company other than distribution to pay income taxes until that seller note is repaid. But I think it'd be pretty difficult to set aside any percentage of profits or revenue. Let's see what else we got.
Bob, I had one just on with regard to the states, is just how on top of the states are they with regard to people changing domicile?
Okay.
And we're definitely seeing, especially here in Massachusetts, like I said, with our new millionaires tax, seeing, folks have the ability and the willingness to move out of the state, that the states are actively pursuing individuals. California, New York, Massachusetts, probably at the top of the list. Connecticut, Pennsylvania, not far behind, of looking to see, where are you filing? They know what address is on your tax documents. They know where your 1099s are being mailed. So we are seeing an uptick in the number of domicile audits. So, and they'll look at things like, where are you using your ATM card? One of the newer things is they'll want cell phone records. Which towers is your cell phone pinging off of to see where you are? So the sophistication of auditing has definitely increased, and it's something to have that conversation. If you are going to change domicile, know what impact it has, obviously, as we've talked about here, but also know what you need to do to put yourself in the best position to defend yourself, when it happens. Not maybe if it happens, but when it does.
Okay. Thank you, Laura.
Bob, there's just one question on how pre-revenue companies are being valued. So being an investor myself in a company which used to be pre-revenue, I can tell you that the starting point is the contributed capital, the equity at day one or day zero, if you will, and then especially in the earlier rounds until you achieve some sort of sustainable revenue profile, it's really about the pre-money valuation, right? And then the contributed capital in the form of equity increase to come up the post-money valuation. Okay, but generally speaking, as a starting point, it's just the contributed capital by the initial investors or founders. Okay, and then once the company achieves, as I said, sustainable level of revenue, then you would switch to some sort of a market approach, which is looking at comparable companies and really then the growth profile and the cash burn and all of the above.
Okay. Let's see. One question here is where do we see the 2024 deal volume? So once again, we feel like it's going to be pretty in line with 2023. The first half of this year being a bit softer. We're hoping things will kind of get a little stronger in the second half. Maybe there's some slight impact from the election. Let's see what interest rates do. I think we all felt like there'd be 3 or 4 interest rate cuts. And now, personally, not the firm's view, but my own view is I think maybe we see one and it happens in December. But, we're thinking around 16,000 kind of transactions, give or take a couple percent for this year. I think we've pretty much covered most of the questions.
There was one more, Bob, around a typical time or timing with respect to preparing a company for sale,
Right.
and what the typical timeline for the actual deal would be. I think, you probably can agree with me, Bob, that every situation is inherently, idiosyncratic, right? It's all specific, but the preparation phase can be just a couple of months, or it can be dictated by a number of considerations, right? The quality of the underlying financials being one, right? The fact that there might be liabilities or potential liabilities that would need to be addressed before the process is being launched, whether it's on the tax side, on the environmental side, or a pending litigation, right? So you may want to think about those before you can even contemplate launching a process. Now, the typical timeline, I would say on average, I think 6 months is probably a good ballpark. I worked on deals that were 4 months long. My sense is that the more competitive and the more quality the business is, then the shorter the process is.
Yep.
Right. But
Yep.
and generally speaking, if a process drags, it's because of company performance, really. But I would think that 6 months is probably the right ballpark.
Yeah, 6 months is a good amount of time, and it's great to start preparing even further ahead. But as Alberto said, we have clients like one right now where they're pretty much, the financials are good, everything, there's no real big issues. We're going to be in market in 60 to 70 days from getting engaged. We have another situation that we just signed up. We're already planning to go to market 12 months from now because there's some specific things within the company and some tax planning. So, always good to start as early as possible.
And I would just say, if there is going to be a charitable component to that sale, it's minimum of 6 months to have plenty of
Right.
separation between your donation date and any LOI or sale.
Yeah, and estate planning and gifting and all of that. So
Yeah.
I think we're going to wrap it up here. We just have a few minutes left. So, I'm going to turn it back over to Alana here, but just want to thank everyone for taking the time. If we didn't answer your question, we will try to get back to you. Feel free to reach out to us. And I will turn it over to Alana to wrap us up. Alana, we can't hear
We
you.
cannot hear you. Yeah.
Can you hear me now?
Yes.
Okay. Thanks, Bob. Thank you to our speakers, and thank you everyone for attending. If you have not completed it already, we have launched our survey located in the survey tab of your panel. A copy of the PowerPoint slides and a recording of today's webinar will be made available to attendees via email 24 hours post-event. Thank you again, and have a great rest of your day.
Thank you, everyone.
Thank you, everyone.
Thank you.